Hey, what's up, everybody? It is Monday, January 17th. Monday, I just sent out the new issue of MMT Trader. Today's a holiday, Martin Luther King Day. So the markets were closed or very thin, depending on what market you were looking at. So we will have a shortened week. Let's talk a little bit about what is happening with Fed monetary policy, specifically the Fed's intention to raise rates. Right now, I believe there's something like a 94% probability of a rate hike at the March meeting. That is right now what Fed fund futures are pricing in, and there's something like a 5.5% probability of a 50 basis point rate hike. I've been hearing the talk of a 50 basis point circulating around now, like the Fed is gonna, deliver a shocker. And that would be a shock because, like I said, there's only like a 5.5% probability right now. I mean, that might go up, but I wouldn't discount that possibility. The Fed's rhetoric has been pretty hawkish recently. They're probably getting some pressure from the White House. Hey, you got to do something about inflation because this is a big problem for our chances in the midterms. So who knows? But once again, I mean, high rates are not going to squash inflation. I don't want to go through this, and beat a dead horse, but, even Peter Schiff understands this, that rate hikes are passed along in many forms, just a higher cost of credit, and the cost of credit is reflected in the cost of all goods and services. So that is not going to stop. One interesting thing I should mention is that the Chinese central bank cut rates today for the first time in 2 years. They seem to be moving in a contrary way to the Western central banks. The Western central bank, the Fed, Australia, UK, New Zealand, etc. So they're moving in the opposite direction, and the yuan went up as it's supposed to do. The dollar is really the only thing that's a little bit of an aberration in terms of its behavior with monetary policy, but that's because the dollar is so widely traded, and the portfolio flows are based on this perception, this wrong understanding of the way rate adjustments affect currency. I mean, rate hikes are inflationary and the currency should not go up. We've seen that in many, many examples that I continue to point out here. I mean, in Venezuela, in Turkey, in Russia. I mean, we've seen so many, in Argentina, we've seen so many, in Brazil, right? I mean, hey, we keep raising the rate and we don't understand why inflation is not going down or why the currency is not getting stronger. It's like, the woodcutter who says, I keep cutting the wood, but it's still too short. Well, because you keep doing the same thing over, and that's not what you need to do to rectify the situation. But this is classic, central bank thinking. This is mainstream economics, which is completely out of paradigm or has it backwards. It has the understanding backwards. The dollar has been selling off, and I suspect that the sell-off will accelerate once the Fed gets into its rate hike groove in March. So I'm anticipating that. Let's talk a little bit about the bond market where, we continue to see a lot of speculative selling. How do I know that? Because if you look at futures commitments of traders, small speculators, again, I think they're up to about 280,000 net short. That's like 28 billion net short in the week. And the banks continue to buy bonds. In the week ending January 5th, which is the latest data, banks bought 60 billion of Treasury and agency securities. About 10 billion of that were pure Treasuries. They bought a record 50 billion of mortgage-backed securities, 50 billion in a single week. That was a record, January 5th. So the banks are stepping up, and they actually have been using, I've been talking about the drop in reserve balances at the banks. That's down 345 billion in the last 4 weeks. $345 billion. It's at the lowest level. Reserves now are at the lowest level in 7 months. So what this means is that, that creates some space on the bank's balance sheet to add other assets. Now they've been adding loans, although in the most recent week, January 5th, it was a small dip in loan volume, and that was mostly real estate loans that dragged it down. Commercial and industrial loans were up again for the 7th week. I think 7 weeks up for like $77 billion of an increase. But now with that additional space on their balance sheet, they're going heavy into buying treasuries and buying MBS and buying agency securities. And they're playing the contrary bet right here. They're going in long heavily right now. They're playing the contrary bet. And when rates start to stabilize, or if they start to come down, I mean, we're still looking at Fed rate hikes. Banks are, they stand to make a big killing on this position. Well, I just want to let you know that, while everything looks bleak in the bond market, banks are aggressively buying this. Cash securities, Treasury and agency, MBS, all that stuff. So they're loading up on the decline, and, they're strong hands. I mean, so they see value here, and I would take that into consideration if you're thinking about, or if you're short the bond market. It's not a good timing indicator. I mean, they could step up and continue buying for a while. It doesn't mean you're going to get a turn, but it is something to pay attention to. I've noticed that their volume has increased significantly. What else? Oil producers were selling into the rally for the 3rd week in a row, but they're still net long. They're just trimming their long position. Got to wait to see when these guys flip net short, if they do. Gold producers, aggressive buyers in the week ending January 11th. They stepped up and added a bunch of new longs, and that was a little bit out of character for them because they did that in a week when the price actually went up. I mean, usually you see them buy when the price goes down, but they did that in a somewhat quiet week, and they were adding new longs, so pretty interesting. Anyway, that's the update. I got all of this in my report. If you want to get a copy of that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial, or send me an email at mnorman@pitbulleconomics.com if you want to talk to me about having an individual subscription at a reduced rate. So, see everybody tomorrow. Enjoy the rest of the day. Bye.